coming right off the heels strong of the bullish trading strategies we covered in the last module. Now we're going to go through the trading choices that you can make in a bear market to profit. So there's a lot of strategies that are going to be similar to the bullish trading strategies, but they're all the inverse of that. So you're going to learn things like buying a long put option, buying a vertical put spread, selling a vertical call spread, and also buying an out of the money put calendar spread. Also going to teach you how to buy a put diagonal spread and using those same leap strategies, but buying long-term put options for your leaps and being able to kind of use that same technology and methodology by financing them. I'm also going to give you some insight into selling a naked put option, which you probably won't use because it's more very advanced, but it's good for you to know just in case. So just like in the bull market previous module, we're going to go through all the different strategies available for you to profit in a bear market and being able to choose the right one that fits your risk profile and the strategy that's going to be best suited for you. So this is going to be even more fun because now you're going to see how you can make money in a bull market in the last module. Now it's time to make money in a bear market. So let's go ahead and jump right in. When you buy a put option, this means you are short the stock or bearish and you think it's going lower. You want to buy to open and sell to close. You're going to learn how to be buying and selling at the theoretical mid price to get the fair, most accurate price on that current contract. When you're buying a put, there's a checklist. Things like you want to make sure the stock is in a downtrend. You want to give yourself at least that 3-month time cushion. You want to see a large volume spike to the downside. Also, you want to see bouncing down from the resistance levels or the moving averages, whatever different indicators you use, it's important that you have those also moving lower, maybe in an overbought, breaking down through the upper threshold. Also, bearish candlesticks can help. And you can see right here where the break even is. The way you determine your break even is the cost of your put subtracted from the purchase strike price. Even though you want to be in a downtrend overall, it's okay to be in a sideways trend, especially when the underlying stock that you're trading is in a pretty strong downtrend. Go out, give ourselves some time. Let's look at the December options. 177 days till expiration. If we wanted to buy, technically you could buy the September options because they're right at that 90-day mark, but just beware that with that shorter expiration, these are going to decay a lot faster than the longer term ones. For me, buying the 90 put is out of the money, yes. However, there's enough time on that to substantiate that decision. Sell a vertical call spread, and this strategy is also known as a bear call spread. So in this instance, we're going to be selling a call and buying a further out of the money call in the same month and doing so simultaneously. And the width of the spread minus the net credit is the maximum risk of the trade. And the purpose of this trade is of course to get bearish or short deltas while generating income from the positive time decay options as a net premium seller. And bear call spreads are made up of negative delta, flat gamma, positive theta, and neutral vega. It's perfectly fine to take off a spread early, not realize that max profit, and put that fresh capital to work in a new trade if it's being threatened as you're moving into expiration. This position that was created, and again, it had all the signals. We're in a downtrend, we had a cross in the DMI, stochastics moving lower, and it hit its head. So I got in right around 158.75 was the stock price when I got that spread filled. Moved down about $3, and that $3 move might not seem like a lot, and it technically really isn't a lot, but that $3 down move created a $400 profit for this small little spread. This here is what I like, and 72% roughly, 449, very liquid, 10-cent wide bid-ask spread, very attractive. And if we right click on this and we go to sell vertical, that's how you sell a bear call spread. And now it's going to auto populate to a 50-cent wide strike. If we modify this to a $3 wide spread, then you can see how our credit gets a little larger, about close to $1. Buy an out of the money put counter spread. With a long put counter spread, it's going to be the purchase of a longer term put option and the simultaneous sale of a shorter term put option. So it's a two-legged trade. A long put counter spread can be constructed at all different strike prices and expiration months depending what you want your Greek risk overall to look like. Further out of the money you go, yes, you'll have a higher delta, but the flip side is you'll have oftentimes a a larger negative theta. Calendar spreads, they're also referred to as time spreads or horizontal spreads. Step one, identify the trend. When you look at a chart and you can identify that you're making lower highs and lower lows, we have a low in here, we have a double top really at 183, we have a high here, a lower high, we have a gap down, broke through this support level right here around 177.5, and it could be a good time to look at putting on an out of the money put calendar spread. Read the internals, read the option chains, make trades the right way at the right prices, and know that you have the ability to modify and adjust as you see fit. Sell a naked call option, and this is the experienced option trader's way to leverage negative deltas and get short a security. It has unlimited risk because a stock price can rise to infinity, theoretically speaking, so when you put this trade on, it's an undefined risk. Short naked calls have negative delta, negative gamma, and negative vega. To sell a naked call option, all you do is left click on the bid. That's how you initiate that trade. When you're selling a naked call option, it's a riskier trade. If you're getting close to expiration and you have something that's somewhat threatening the strike price that you're selling, I mean, if you're selling a 200 strike call naked, the stock's at 195, that's relatively close. That's technically at risk. The other thing I want to point out is that if you do have a sold naked call option, you can always buy a further out of the money call and leg in to a bear call spread. And we're going to go over all the different ones that you learned about, and the first one was to buy a put option, buy a vertical put spread, sell a vertical call spread, buy a put calendar spread, the put diagonal spread, sell a naked call. And then the last one here was buying a leaps put option. And this is going to be something we'll be building on throughout the program, especially in the next module when you learn how to profit and learn those sideways option trading strategies. All of these modules are building on each other, so it's very exciting. We're getting towards the end, so I'll see you in the next module, module 11, when you learn about the sideways option trading strategies.